Greetings and welcome to the fourth quarter fiscal 2020 earnings call. During the presentation, all participants will be in a listen-only mode. Afterwards, we will conduct a question-and-answer session. At that time, if you have a question, please press the 1 followed by the 4 on your telephone. If at any time the conference is to reach an operator, you press the star followed by the 0. As a reminder, this conference is being recorded Wednesday, July 1st, 2020. Now, I would like to turn the call over to Mr. Jeff Seaman. Please go right ahead.
Thank you, Tommy, and good morning, everyone. Thanks for joining us for our Q&A session on our fourth quarter results and full year results this morning. I hope everyone had time to review our press release, listen to our prepared remarks, and view our presentation materials, which are available on our investor relations site. It's also important to note that in our Q&A session this morning, we may make forward-looking statements that are based on management's current views and assumptions, including facts and assumptions related to the impact of the COVID-19 pandemic on our fiscal 21 outlook. Please refer to this morning's press release for factors that could impact forward-looking statements and for reconciliations of non-GAAP information, which may be discussed on today's call. I'm here virtually with Jeff Harmening, our Chairman and CEO, Kofi Bruce, our CFO, and John Nudi, Group President of North America Retail. We're holding this call from different locations, so hopefully our technology cooperates and everything goes smoothly. With that, let's go ahead and get to the first question. Tommy, can you please get us started?
Absolutely, thank you. And once again, before we start, as a reminder to register for a question, it is the 1 followed by the 4 on your telephone, and you'll hear a 3-tone prompt to acknowledge your request. If your question has been asked or you'd like to draw your registration, it is the 1 followed by the 3. And we'll proceed with our first question on the line. It's from the line of Andrew Lazar with Barclays. Go right ahead.
Good morning, everybody, and thanks very much for all the change in the earnings release format this morning. Very helpful.
Morning, Andrew.
Morning, Andrew.
Hey, maybe to start, I was hoping to focus on sort of the underlying business momentum, if I could. And I know it's a little harder to get at now, obviously, given everything that's going on. But I think on the third quarter call, General Mills had said that, excluding the pandemic impact, it would be at the low end of its full-year organic sales growth range of 1% to 2%. And I think that Blue Buffalo coming into the base adds about a point. So I guess underlying business trends, at least as of 3Q, roughly call it flattish, your expectation for the year. So I think my question was, again, excluding the pandemic, I guess would General Mills have been considering fiscal 21 to kind of still be somewhat of an incremental reinvestment year to really shore up sort of organic growth and build on the recent improvements you've seen in categories like snack bars and yogurt and things like that?
Yes, Andrew, your math is right on that. And, as I've said before, we try to stay in the middle of the boat. And one of the ways we do that is by continuing to reinvest in our business. And you see the results in the fourth quarter included a pretty significant step up on our marketing spending. And actually, we think, our strength at the beginning of June, especially in North America Retail, is due to the fact that we are spending money on marketing because our promotion levels are actually down in June, and our growth is still double digits. And so we believe in investment and marketing, and you saw that in the fourth quarter, and you'll see that again in fiscal 21. You'll also see investments for us in capabilities, particularly on the data and analytics side, to drive both our sales growth through things like e-commerce and strategic revenue management, as well as cost savings projects like procurement. And so whether COVID or not, we had planned to reinvest some of the earnings growth back into sustained top-line sales growth, and that is our plan going into next year currently.
And then I guess lastly, it's really on inventory, specifically at the consumer pantry level. I think in today's release, you mentioned that there's the potential for sort of pantry inventory drawdowns moving forward. And I'm curious if this is simply a pet food comment, which I think would make sense, or a broader portfolio comment. Because to me, I guess it seems that consumers have been both consuming and replenishing, a lot of your center store products rather than stocking up. So I'm just curious if that's something that you're already starting to see or anticipate in fiscal 21, or more of a broader just, hey, at some point, just given how strong, shipments have been, we should just keep an eye out for this, if you get what I'm asking.
Yeah. So Andrew, let me answer broadly and then specifically on pet, and then I'll have John Nudi answer more specifically on North America retail. Broadly, as you can see in the strength in the Nielsen data on the human food side, month to month to month, while there certainly was a stock up in March, and you can see that in the data, consumers are clearly still buying and eating through the stock that they have on hand, and so. That is consistent with what we thought would happen at the beginning of the quarter when we saw the stock up, and in fact it happened throughout the quarter, and again it continues into June with some double-digit growth on the human food side of the business. On pet food we saw something different, and again consistent with what we expected, which is given that pets don't eat a tremendous amount at restaurants, we thought that there would be, when we saw the stock up in March, people were asking us, is this because there is a lot of dogs coming out of shelters, and the answer is no, people are just stocking up, and we expect that to reverse in April and May, and largely it has reversed in April and May. There may be a little bit more to unwind as we begin our new fiscal year in the pet food category, but a lot of that has unwound already, and so what we see in pet is different than what we see in the human food side, both of which we expected. And John Nudi, anything specific you'd like to add on that?
Yeah, thanks, Jeff, and good morning, Andrew. So maybe I'll touch on consumer inventory levels or pantry levels, and I'm sure a question on many people's minds too are just customer inventory levels, so maybe I'll go there as well. So from a consumer standpoint, at least in North America, we believe that the majority of the product that we've moved to consumers has been consumed. We do believe that consumers are keeping slightly higher levels of inventory in their pantries, but we do expect that to continue. Obviously, as it's a really dynamic environment with the pandemic still, raging across the country. From a customer standpoint, we did see a drawdown in customer inventories over Q4. I guess just to quantify it, so for Q4 and our organic growth was 28%. Our movement was higher though. In the U.S. it was up 37%, in Canada it was up 20%. And really that difference was all driven by retailers pulling down inventories, obviously trying to keep products on the shelf. We would expect that to come back at some point in fiscal 21. At this point we don't have a great idea of when and to what extent it will come back. But definitely we saw retailers pull down inventories during Q4.
Great. Thanks so much for that, everybody.
Thank you. We'll get to our next question on the line. It's from the line of Ken Goldman with J.P. Morgan. Go right ahead with the question.
Hi, good morning. Thank you. And I second Andrew's comments. I do like this format, so hopefully we'll keep it going ahead. Right. I did want to ask two questions, if I can. First, you mentioned some headwinds to your operating margin in fiscal 21. You talked about some higher input costs, supply chain costs, spending on brands and capabilities, and COVID-related costs. Is it possible to sort of bucket or rank order these just so we kind of get a sense of which are going to be the bigger headwinds and which are going to be maybe some of the smaller ones?
Kofi, you want to field that one?
Absolutely. So I think great question and good morning. As you look at these, we would reference first as we're coming out of our Q4, we did see higher operating costs as well as COVID-related costs. The split between those two is roughly we had about $100 million in higher sort of COVID-related costs. I would say the split between those two is 2/3, 1/3, with 2/3 being comprised of the operating costs, things such as crewing, external supply chain, trucking premiums, and then on the other side, the wellness costs, everything from personal protective equipment, wellness policies. So we would expect that to be a continued headwind as we step into F21, as a portion of those costs will continue. Obviously, we can't quantify that because a lot of that will be tied to the pandemic, the pace of the virus spread, and obviously the pace of demand to the extent that the operating costs are directly tied to our ability to source product. Does that get at your question?
Yeah, that's perfect. I'll follow up with more details later, but that's helpful. For a quick follow-up, we've heard some rumblings in the industry that maybe some retailers will get a little bit more aggressive on pricing in the back half of the calendar year, just to help out some of the consumers that may start to struggle more as unemployment lasts longer and perhaps some of the stimulus checks fade. And I'm just curious if you're hearing anything similar, It doesn't necessarily make sense for me for retailers to be pulling down prices right now. I'm not sure in an environment where there's out of stocks that's the most logical maneuver, but I'm just curious if you're hearing anything along those lines that you can share with us, or whether that's misguided.
So John Nudi, you want to field that?
Sure. So good morning, Ken. In terms of promotional support, obviously in Q4 we saw retailers pull back on promotion as the focus was on keeping products in stock. As we moved into May and early June, we saw our promotional levels get back to more normal levels in most of our categories. And as we look to plan through the rest of the year, we're planning on normal levels. So we have not really been faced with any asks for deep discounts or deep promotional pricing. The one thing I would add is, there's certain categories that we are constrained from a supply chain standpoint, a capacity standpoint. So even if there was a desire to, go hotter from a promotional standpoint, we just don't have the capacity to do that. So I think that's going to be a limiting factor across many of our categories. So I guess to answer your question specifically, we have not had those discussions, and even if they come, again, I think we're going to be limited with what we can do.
Great. Thanks, everyone.
Thank you very much. We'll get to our next question on the line. It's from Chris Growe with Stifel. Go right ahead with your question.
Hi, good morning.
Morning, Chris.
And I will third that, if that's the right word, for appreciating the new format. So thank you for that as well. I did want to ask, in terms of the decision not to provide guidance for the year, you have given a lot of components and things to how to help us get there, if you will, but and I know that there's a lot of volatility in the business, no doubt. As I think about giving an indication of roughly a flat operating margin for the year, I'm just curious, as you look at the volatility in the business, sort of where you get that confidence. Is it that the way you're going to manage the business this year? Is it that you have a good sense of kind of where sales will shake out, and therefore you've been able to give the confidence in that operating margin outlook for the year? Just curious how you think about that.
Yeah, thanks, Chris. This is Jeff Harmening. I'm glad you asked that. First, I guess I'd like to start by saying the fact that we didn't issue formal financial guidance is not a reflection of conservatism, and it's not a reflection of lack of confidence. It's actually an understanding that a big determinant of how much we grow this coming year will be, how the pandemic plays out, and that is highly uncertain as it relates to the duration and depth of the pandemic. So I don't want anyone on the call to read into it that it's a lack of confidence or actually conservatism. In fact, we think our business will grow over the first 3 quarters relative to what it was pre-pandemic levels. And that's because now we're in a period where people are still staying at home. They're working from home. Many restaurants are either closed or people don't want to visit. And to a question that Ken Goldman asked earlier, we think that'll be followed by a recession. And if you look back to the last recession, General Mills performed quite well. And so we think there will be an environment where we'll be able to grow for the first 3 quarters, followed by a fourth quarter comparison. Obviously, that'll be very, very difficult. The other thing, I guess, to highlight is that our confidence stems from the fact that we've executed really well. We're confident that we will emerge from the pandemic in the last few months as a stronger company, and as witnessed by our share growth in 9 of our top 10 categories in the U.S., by being the 3rd fastest grower in Europe and leading share growth in our categories in Europe, and growing in our categories in Brazil, and growing Wanchai Ferry double digits in China. So I think hopefully what you hear is a company that is confident that the things that we can control, we have a good visibility to. And I would say on top of that, our marketing is particularly good right now, whether it's North America retail and things like Honey Nut Cheerios, or we're very bullish on pet and continue to be bullish on pet after posting another year of double-digit retail sales growth and 18% reported net sales growth in the year. So that's kind of where we stand. And the reason we didn't provide guidance was because the environment is so unpredictable with the pandemic. Mm-hmm. That's why.
That's a good answer. Thank you for that. Just a quick follow-on to that. So you've talked about generating efficiencies to incrementally invest in the business in fiscal 21. You have HMM savings coming through around 4% of cost of goods sold. You got inflation around 3%. Is that the gap that you hope, or part of which you hope to reinvest? And is it, if we think about generating efficiencies, is that incremental to what you expect for HMM right now? You hope to have even more savings to reinvest? Just want to see if I can kind of frame that opportunity.
So, Kofi, why don't I leave that one to you?
Sure, absolutely. Hey, Chris, how are you?
Hi.
Yeah, we are expecting to reinvest a portion of that gap in capabilities, but as you can imagine, and to my earlier question again, I think the challenge in operating in this environment is that demand and demand for at-home food is probably the single hardest thing to predict, and so we will be focused on managing the middle of our P&L so that we can deal with the potentially higher operating costs. And so as we think right now, we have that balanced. We think the capabilities investments will help us advance our long-term goals. I don't want to quantify those for competitive reasons, but they're meaningful enough for us to continue to make progress on our capabilities. So I hope that gets at your question.
It does. Thanks so much for that color.
You bet.
Thank you very much. Get to our next question on the line from Alexia Howard with Bernstein. Go right ahead.
Good morning, everyone.
Morning.
Morning, Alexia.
Morning.
Hi.
Morning.
So two from firstly, on the incentive compensation, I assume that was a fairly big step up this quarter, given the strength. I was wondering if you were able to roughly quantify how much that inflated the SG&A line this time around. And then thinking out through fiscal 21, how does incentive compensation work for next fiscal year if there's no guidance and no formal sort of goals at this point? And then my follow-up question is, you mentioned as one of your goals the desire to reduce leverage further to increase financial flexibility. Does that mean that your M&A pipeline is, or that you're actively out there looking for potential deals? And if so, in which areas are you perhaps looking most closely to do that? Thank you.
So, Kofi, I'll have you field those series of questions from Alexia.
Okay, thanks. Hi, Alexia. How are you doing? So I would say, let me start first with incentive, and I would say it is a big driver, obviously, in the quarter in our SG&A line. So it is obviously a tailwind this year, headwind this year, and we would expect it to be a tailwind next year. Obviously, I can't go into a tremendous amount of detail, but just know that we will be effectively setting our targets based upon in a dynamic environment, and all companies are dealing with this, but we would expect, based on everything we know right now, for this to be a tailwind. All things being equal on leverage, we're pleased with the progress we've made on debt leverage. I think at the start of the Blue Buffalo acquisition about 2 years ago, we had a target to get down to 3.5 times. By the end of this fiscal year, we are at 3.2 times, so we are pleased to be slightly ahead of schedule and on pace to get to our long-term goal of 3 times. I think at that point, then we will start to look at resuming our normal capital allocation policies, with the first priority being focused on increasing the dividend rate.
Alexia, this is Jeff Seaman. I would just add a quick color on the incentive piece. We always plan versus our internal plan, and incentive at the beginning of the year would be 100 payout. If we beat our plan, that's a headwind in the year, but obviously good news for our shareholders as we would have exceeded our goals. That's what played out in 20. We have an internal plan for fiscal 21, and so assuming we deliver that plan, we'd be paying out less than we did in 20. But obviously, if we beat our plan, that could change.
Great. Thank you very much. I'll pass it on.
Thank you. We'll get to our next question on the line from Dara Mohsenian with Morgan Stanley. Go right ahead.
Hey, good morning, guys. Hope all is well. So Jeff, or maybe John, obviously a large step up in consumer demand in any retail post-COVID. There's obviously some increased trial there. Can you spend some time discussing how much of the higher demand was due to new trial of your products based on your consumer survey work and bringing new customers in? And as you look going forward, longer term, your ability to potentially hold on to those customers and what the strategies would be to do so. Thanks.
So let me start with this question, and then I'm going to pass it over to John Nudi to provide some added detail. One of the things I'm most proud of our company over the last 3 months, especially in North America retail, is that we have gained penetration across all of our categories. And if you look at 52 weeks, which is an even better way to look at it, all but maybe one category, we've increased household penetration, which is the highest correlation to growth. And so I'm really pleased with what our team's been able to do. Obviously, it varies by category. So, John Nudi, you want to provide any color or any insights?
Yeah, absolutely. So, I guess when you look at penetration, we do believe it's important to take a longer view. So as Jeff mentioned, when you look over 52 weeks versus pre-pandemic levels, we grew penetration in the majority of our categories. Importantly, too, we outpaced our categories in terms of our performance and the penetration we are growing. The highest growth and penetration were areas in our meals and baking areas, so things like soup, Pillsbury refrigerated baked goods, desserts, and flour. And we saw some significant gains. And for us, 2 points of penetration equals about 2.5 million U.S. households. So again, it's significant. And importantly, too, I mean, it's when you look at it a year ago, we grew penetration in 7 of our top 10 categories. So again, it's not just prior to the pandemic, versus a year ago, we're growing overall in the majority of our categories. And we're starting to look at repeat. I'd say it's still early days, and again, we need a bit more time to really understand that. But repeat amongst our new households is strongest and really outpacing our categories as well. And what's exciting to us, again, our highest repeat rates are in things like Cheerios, the franchise, Cheerios franchise, Pillsbury RBG, desserts, Annie's mac and cheese, and Old El Paso. So we worked hard over the last decade, frankly, to really improve our products, whether that's improving the ingredient deck, making sure that they tasted the best they possibly could. And we think that many consumers are trying our products for the first time or coming back after many years and finding a better experience. So we think that'll bode well for us as we move into fiscal 21 and beyond.
And I would like to add on to I'd like to add on to John's comments that everything that John said about North America retail is also true for all of our categories in Europe, as well as our Wanchai Ferry business in China, which saw significant penetration gains, as well as our at-home business in Brazil, which is the vast majority of our Brazilian business. And so whether you look at North America retail or Europe or China or Brazil, our major markets, we've experienced strong penetration gains in all of our at-home businesses.
Okay, great. And then can you also touch on e-commerce performance in the quarter and the changes you've made in that business to take advantage of higher channel growth online from a category perspective going forward?
Well, if we look at e-commerce broadly across the company, it's roughly 9% of our sales as we exit the fourth quarter with a significant increase. And in all of our geographies and the vast majority of our categories, we over-index online versus bricks and mortar. And there are 2 reasons for that. One is that we've been investing in e-commerce for a number of years. And the second is that we have really good brands, and we have a lot of the biggest brands. And when you're shopping online, those are the brands that tend to do well. And so for both of those reasons, we have seen outsized growth in e-commerce over this period as we look globally. It's been particularly acute in the U.S. And John Nudi, you want to comment a little bit on what we've seen in terms of U.S. growth in e-commerce?
Yeah, sure, Jeff. So specifically for the U.S., we saw a 250% increase in our e-commerce business in Q4. Importantly, now almost 50% of all U.S. households have purchased food and beverage products over the last year. So again, that's a significant step up of about 7 points versus the prior year from a penetration standpoint. And probably the biggest limiter in terms of why the growth couldn't have been even higher is just our retailers and their capacity to really deliver to consumers' homes and even click and collect the number of slots that they had. So we're working with our retail partners to make sure that we optimize our e-commerce business with them. Increasingly, we're really connecting into their data and making sure that we take an omni-channel approach to making sure whether the consumer wants to shop in the store or shop online, they're seeing consistent campaigns. And then really working from a supply chain standpoint as well to make sure that we can deliver products to our consumers, to our customers who will ultimately get it to our consumers. So we're excited about e-commerce, and as Jeff mentioned, we've been working on this for multiple years, and it's really paying off. In the U.S. alone, we have a 110 index to bricks and mortar. So again, to the extent we sell more online, that's good for us.
Great. Thanks, guys. Appreciate it.
Thank you very much. Now we'll get to our next question on the line from John Baumgartner with Wells Fargo. Go right ahead.
Good morning. Thanks for the question.
Good morning, John.
Jeff, or maybe John, I wanted to ask about product mix. You had the drag in Q4 from the comp at Buff and the composition of the tonnage at NAR. But if you step back and think more structurally, one of the things we hear from investors is that there isn't any pricing power in food. But to the extent that the innovation is on trend, you're margining up already with new products at Buff and in snacks and yogurt. How do you think about your capacity to capture stronger mix on a consistent basis across your portfolio in a COVID world, even if the flexibility to move list prices may not be ideal?
So as we think about it as a company, what you saw is positive price mix in the fourth quarter because we sold a lot more through North America retail and we sold a lot more through pet food. And so to the extent that we keep growing pet, and we certainly plan to do that, and we see elevated demand in North America retail, that actually bodes pretty well for price mix as we think about it on a company level. It gets more complicated when you look within a geography, but let me have John Nudi answer how it has played out in North America retail, over the last quarter, because it's important, but it's complicated when you look at it.
Yeah, thanks, Jeff, and good morning, John. When you look at price mix, we look at it in two ways. One, in the P&L, which is done on a per pound basis, and then also in Nielsen, which is on a per unit basis. And you saw some very different things in Q4 if you look at those different ways. So from a P&L standpoint, through the first three quarters, our price mix was actually flat. And again, that's on a per pound basis. On Q4, to your point, it was down 7 points, so it was a significant drag. But it was 100% driven by mix as we sold heavier products, so things like soup, desserts, and flour, as well as larger size packs as consumers really moved that way. When you look at Nielsen, though, on a per unit basis, we actually saw an increase in price mix in Q4, really driven by less promotion and favorable customer mix. So we feel like there is some pricing power out there. And one of the things, again, we've worked hard at over the last few years is strategic revenue management, really building a toolbox that allows us to have different levers to pull given the environment. So I think as we look towards fiscal 21, you'll likely see less list pricing just as inflation won't warrant it, and it'll be obviously a competitive environment and value will matter. But things like price pack architecture and mix will be things that we focus on. And the good news, again, having been at this a while, we've got a pipeline of ideas in our toolbox that we'll be able to execute against. So we continue to expect to drive price mix in fiscal 21. It'll probably just look a little different than how we drove it in fiscal 20.
And I guess just to build on that, maybe come back to Jeff, thinking about Blue Buffalo, some of the price per pound premiums on the new products and wet and treats, they're pretty sizable versus the base portfolio. Is there anything you're seeing out there where there's an elasticity for consumers or kind of a pushback on pricing, or do you feel as though there's still a runway to go with the mixed premiumization as long as the innovation is on trend?
Yeah, with regard to pet, we think there's a ways to go, and if you look at the growth of the pet category, first of all, the pet category is growing mid-single digits, and it's primarily on pricing. And the part of the category that's growing the fastest is the premium part of the category. So we certainly think there is a place to play there. And Blue Buffalo, we believe, is the best equity in that premium space. And I think our growth over the last couple of years would add some credence to that. We also know that people care deeply about their pets, and especially in a time of high anxiety, which I think under any circumstance you could qualify this as a time of high anxiety. People rely on their pets, and the last thing they want to do is cheat their pets and the source of comfort. So what we see in the marketplace, whether it's through recession or whether it's through a time like this, is that one of the last things that people are interested in skimping on are their pets. And so they don't do that, and we see that being played out in the market right now.
Great. Thank you.
Yeah.
Thank you very much. We'll get to our next question on the line from Jason English with Goldman Sachs. Go right ahead.
Hey, good morning, folks. Thank you for slotting me in, and congrats to you and your teams for navigating this very turbulent situation. Especially kudos to your supply chain. I've got to believe this is very challenging for them. My questions, I guess we just closed on pets, so maybe we could pick it back up there. There's obviously a lot of noise in reported results this quarter because of what you're comping and the extra days. Can you give us a beat on how retail sales are tracking across all channels in the quarter and what you're seeing so far as we roll into the new fiscal year?
Yeah, so thanks, Jason, and appreciate the support for how we've executed the last quarter. We feel really good about it. As you said, our supply chain has held up remarkably well, and we've driven those supply chain gains all the way through our sales organization to our customers, and feel very good about how we've serviced the business and serviced demand in a time when people really need it. When we look at Blue Buffalo, let me take a step back. For the year, we grew reported net sales 18%. Through 3 quarters, we were up 11%. And in the last quarter of the year, we believe that our retail sales were up somewhere in the high single digit range. And so for the year, we had guided to 8 to 10% like-for-like growth, and we're confident we exceeded that somewhere about the 12% range. So for the year, we over-delivered on what we said we did, so we feel great about that. In the fourth quarter, you're right, there is a ton of noise. The retail sales look like they're up high single digits. And again, that's still share-leading growth for the category, a category that's up mid-single digits. So we're really pleased, even amongst the noise, with our performance on Blue Buffalo in the fourth quarter.
That's super helpful information. Thank you for that. And turning back to your North America retail portfolio, as we look at the Nielsen data, your TDPs are down a lot. Your average items per store are down a lot, as they are across the industry. And we've heard from a lot of different companies about SKU rationalization, streamlining portfolios to really maximize capacity. Can you touch on how much streamlining you've accomplished and how much of that streamlining you think you'll be able to sustain, or when, if at all, do you think you're going to start to layer back on those products?
So, John Nudi, why don't you take that and maybe touch on not only the streamlining of distribution, but maybe a couple other actions we've taken to help make our supply chain more efficient.
Yeah, absolutely. So good morning, Jason. Obviously, if you look at distribution in Nielsen, it's a bit of a wild picture right now, as there's out of stocks and other things happening as well. I guess if you think about our business, and we compete across 25 different categories, and the majority of our categories, from a capacity standpoint and a service standpoint, we're in pretty good shape at this point. Our supply chain's done a terrific job keeping our plants running and keeping them safe, importantly, for our employees and obviously for our consumers with the food. So the majority of our categories, we're back up to pretty healthy service levels, and haven't seen a significant decrease from a distribution standpoint with our retailers. And there was a trend prior to the pandemic with retailers really cutting back on the number of SKUs and categories, giving more facings to higher churning SKUs, and that was really driven by e-commerce and click and collect, and obviously having the shelf capacity to service that business. So we expect to see that continue. Now, we have a few categories that we have capacity constraints, soup being one of them, desserts being another one, and we've temporarily withdrawn a significant number of items. So in soup, Progressive Soup, we pre-pandemic had something like 80 items, and now we're down to somewhere around 50. We expect to start phasing some of those back in as we move through the first half of the year. And frankly, some of them probably won't come back. So again, I think we will take the opportunity to make sure that we have an efficient portfolio and one that works for us and works for our consumers. Variety is important, though. When you think about soup, everyone's got their favorite soup flavor. So again, we're going to have to work through that as well. So we feel good about where we are from a distribution standpoint. One of the things the metric that we look at is share of distribution, because again, we do expect total distribution points to decrease as we move throughout the year. And we exited the year, really improving from a total share of distribution standpoint, and that's what we'll continue to stay focused on as we move through fiscal 21.
Good stuff. Thank you, gentlemen. Be well.
Thank you.
Thank you very much. Our next question on the line is from the line of David Palmer with Evercore ISI. Go right ahead with your question.
Thanks. Just want to follow up on what we're maybe seeing in the scanner data lately. It looks like the part that is audited by some of these scanner data companies is showing a reduction in display activity, but some of that might be the fact that they're not auditing that as much. And then I'm wondering if we're seeing some noise in that percent sold on discount, because it looks like within cereal specifically that there's been some increase in percent sold on price discounting, which would seem to run against the times that you wouldn't need to be doing that. So are you seeing some price reductions going on out there? Is there more competitive activity in cereal, or is there noise? And then I'll have a quick follow-up.
John Nudi, why don't you field that one?
Yeah, good morning, David. I would say the short answer is probably noise more than anything. Many of the auditing groups are not going into stores at this point, or if they are, it's inconsistent in terms of what we're seeing. So we're not looking too closely at display facts, and some of the pricing gets really confusing as well. What I would tell you, though, in general, we're not seeing anything out of the ordinary in terms of pricing on cereal. In fact, we pulled back some of our promotions in Q4, particularly on our Cheerios franchise, where we were a bit tight from a capacity standpoint. So again, we're not seeing anything abnormal. And I think from a data standpoint, again, the total movement and is something to look at and something that makes sense. I think when you start getting into some of the facts below that, I wouldn't put a whole lot of stock in it at this point. At least we're not.
Got it. Thank you. And just to follow up on the incentives, you talked about how you did above plan in this last fiscal year because of the fourth quarter and probably caused some truing up in what you were doing in terms of pay for performance. But I'm wondering, are you making adjustments to your annual targets and how you pay people? The board doing that for you and you down to the division levels, and how are you making those adjustments? Because this has to be viewed as an extraordinary period, not just because of Blue and those acquisitions and other calendar effects, but because of this virus and passing that through the python. Any help on that would be helpful.
So David, the board sets our compensation targets as well as ranges for compensation, and I'm not going to go into the depths of that, only to say that it is based on our sales performance and our operating performance, our profitability performance, and weighted equally among those measures. And we pass those kind of things down to our segments. And you're right, it is a dynamic environment, which requires us to be dynamic in our assessment. And certainly one of the things we look at as we assess the performance of our businesses is how competitive are they in the marketplace and how efficient were they in being competitive. And that's why I say we're really proud of our performance. And even in areas like convenience and food service, which was down quite a bit in the fourth quarter, they actually grew share in the majority of their categories. And so they performed well in the fourth quarter, even in an environment that was really, really difficult. And so that's the way we'll continue to incent people. Again, it helps us stay in the middle of the boat in driving sales growth, but not at all costs, and making sure we're efficient while we do it.
Okay, thank you.
Thank you very much. We'll get to our next question on the phone line from Robert Moskow from Credit Suisse. Go right ahead.
Hi, thanks for the question. I guess I have two. The one is on the breakfast cereal category. If I look at the data, I'd say it looks good, but not great. Retail sales were up about 6% in the past 4-week period. It had been up double digit. John and Jeff, are you surprised that the category is not growing faster in an environment like this where we're all kind of stuck at home, we're not eating breakfast on the go, we have the luxury of time in our homes to prepare longer breakfasts for ourselves? Or is this pretty much what you would expect? And the second question is on first quarter. I understand not giving guidance for the year, but can you give us a sense of maybe just North America retail sales? It looks like overall your sales are still up double digit and probably can stay that way for the next 3 months in the retail data. Is that a fair assessment for first quarter trends, John? Thanks.
So let me answer the question on the first quarter trends, and to say that the reason we don't give quarterly guidance is because we've never given quarterly guidance, and we're not going to start now. You're right, Rob, and I'm glad you pointed out our retail sales. If you look at Nielsen, are off to a great start in North America retail. So it gets back to a question I answered earlier. I think it was from Chris Growe about the confidence we have. So it's not a lack of confidence that we're not providing guidance. It's really a matter of, for the year, uncertainty, and for the quarter, the fact that we just don't provide quarterly guidance. On the question of cereal, I'll let John answer that in detail, but I want you to know I am thrilled that you're asking a question about the cereal category being good and not great when it's growing at 6%. So with that, John Nudi, why don't you elaborate on that a little bit?
Yeah, sure. Good morning, Rob. So, we feel good about the cereal category and frankly even better about our performance. So in Q4, the cereal category grew at 26%. We grew at a similar level, and for the full year, the category grew at 5%. And when you go back to even the year prior, we think when you add in non-measured channels, it grew that year as well. So we think the category was heading in the right direction. We like our performance. We've grown share in 11 of the last 12 quarters. We're the clear share leader in the category. We're doing that by having strong marketing campaigns. In fact, prior to the pandemic, we were having the best year from a share standpoint on cereals in over a decade. As we've gotten back to the heart health messaging that works really well, we actually, for the first time ever, changed the shape of the product to a heart for a limited time. That worked incredibly well. And then our innovation is working as well. We had 3 of the top 5 new products in the category last year. So we feel good about the category. We feel good about our performance, and we think we'll continue to grow nicely in fiscal 21.
Okay. I mean, the market share gains, no doubt, stunning. So congrats on that. And we'll see how the category does. Thank you.
Okay, Tommy, I think we're gonna wrap things here. I know we weren't able to get to everyone, but we want to make sure that we respect everyone's time and length on the call. So thank you everybody for your time and attention this morning. Appreciate the interest in General Mills, and we look forward to continuing to keep you updated on how we go from here. If you have follow-up questions today, please feel free to reach out to me, and we'll make sure we get to you. So thanks again.
Thank you very much. Thank you, everyone. That does conclude the conference call for today. We thank you for your participation. As we disconnect your lines, have a good day, everyone.